Private lending is one of the most fastest growing wealth strategies in the world, but right now, cracks are starting to show, and most people don't even see it yet. Today, I'm going to break down the 4 biggest challenges in private lending, who is being affected, and the 3 powerful solutions that smart investors are using right now. Okay? So, first, please make sure you subscribe to the channel so you can get more of this content. So, what is private lending? Section 1. Let me simplify this. Private lending equals money being loaned outside of banks by investors, funds, or institutions to businesses, real estate deals, or individuals. This market has exploded over $1 to $3 trillion globally, and that's huge. Why though? Because banks tightened lending after 2008. Private lenders then said, let me come in and fill the gap. That takes me to section 2, the 4 biggest challenges. Number 1 is the rising defaults, biggest problems. Let's start right here, okay? In 2025, private credit default rates reached 9.2% in some portfolios. Other reports show 5 to 6% and rising into 2026. What this means, if you lend money, more people are not paying you back. Why this is happening? High interest rates, businesses over-leveraged, and a slower economy. Even worse, some forecasts say defaults could go as high as 15% in the worst-case scenario. There's also the issue of weak underwriting, bad deals being made good just to get the sale in, and this is very dangerous. Experts are saying bad underwriting is a major cause of problems. The translation is this: lenders are approving deals too fast, trusting projections that are unrealistic, not verifying risk properly. And why? Because there's just too much money, chasing deals. Over $350 billion raised in recent years created pressure to deploy capital fast. Lack of transparency, you can't even see the risk. Unlike stocks, private lending is not publicly traded, not priced daily, and they're very hard to evaluate. So regulators are now warning about opacity and hiding the risk in the system. Say, for example, you invest $100,000, but you don't really know if the borrower is struggling, if the value dropped, if the deal is even performing. You don't know that. And of course, you have the issue of liquidity problems. You can't get your money back even when you want to get your money back. This is the silent killer of all. Private lending is not liquid, meaning this: you can't just pull your money out anytime. Like go to the bank and withdraw money, you can't. In fact, some funds are restricting withdrawals due to pressure. Assets may be sold at a loss if forced to exit. And the simple version is this: you're stuck. Even if things go bad, you are stuck. That's crazy, right? Now, of course, you have this rising stress sickness right now because loan write-downs have tripled since 2022. High-profile defaults are increasing. So the question, therefore, is who is being affected, which is Section 3. Who is affected? This is the key to understand. Number 1, small, mid-sized businesses. Most private loans go to them. They are the first to default. Mom and pop. Number 2, you got private credit funds managing billions, facing pressure from investors, and they can't handle that pressure. And number 3 is the banks. Yes, the banks too. Banks are now exposed to private lending indirectly. So, which means the risk is actually spreading, as we speak. And of course, you have the everyday investors, especially high-income earners making a lot of money, and they invested. Retirement portfolios went into it. Insurance-linked strategies went into it. And so now it's just this big part that is a lot of people are involved. So given this, what would solutions be? Because this is where now you have to be thinking out of the box. Solution number 1, you need strong underwriting discipline. The smartest lenders are stress testing deals, assuming worst case scenarios. So the stress test, Lending is based on cash flow, not hype. Not just selling the dream. But what does the cash flow look like? The rule is this: if the deal only works in a perfect world, it's not a deal. Number 2, solution. It's called diversification. Never one bet. Smart capital is spread across multiple borrowers, different industries, and different structures. Why though? Because if defaults are rising, concentration equals danger, and everybody needs to know that. Number 3, structure over yield. This is the most important, because most people chase high returns. That's what they do. Smart investors focus on protection and structure. That's what they focus on. For example, senior secured loans, first lien positions, insurance-backed strategies, cash flow structured assets. That's where they put their energy, because you don't lose money when returns are low. You lose money when structure is weak. And this is the reason why a lot of people are looking for a better alternative. Private lending is not going away, by the way. It's actually growing faster than ever, but the game has changed now. The winners in this era won't be the ones chasing returns. I want 10%, 15%, you will lose. They will be the ones who understand the risk, the structure, and the discipline. These are the people that need to be in that market right now. If you want to learn how the wealthy actually structure money in this new era, especially AI era, private lending era, subscribe to this channel and comment wealth below, so I will send you a breakdown, because this situation is real.